Everyone's waiting to buy a house. Here's why that may be a mistake. The US-Iran ceasefire expires Wednesday. Trump says he's highly unlikely to extend it. Who knows? Oil is whipsawing, down 11% last Friday, up 6% today. And through all of this, Canadian housing market just posted its weakest March in 17 years. Everyone's waiting for the war to end, waiting for the Kuzma trade deal with the US to settle, while Mark Carney said that our relationship with the USA is now a weakness. Hope Trump doesn't hear about that. Buyers are waiting for rates to drop before buying a house. But here's what they need to remember. By the time news headlines confirm the bottom is in, the opportunity they describe is often half gone. Today I'm going to show you the fundamentals, explain what needs to break for this market to turn, and to make the case that waiting might be the wrong strategy entirely. Let's get into it. If you're new here, I'm Greg Williamson. I have over 32 years in the mortgage business. This channel exists because I believe mortgages should be managed, like an investment portfolio is managed by experts, not guessed, set it and forget it style mortgages that happen everywhere else. Every week, I cut through the noise and give you a clear strategy, not a hedge, an actual call. This week, let's step back from the daily headlines and look at the fundamentals and why the conventional wisdom might be backwards. Let's start with the thing that's driving everything right now. Oil is still the puppet master, and it's more volatile than ever. WTI crude was at $94 early last week. Then Friday, it plunged 11% when Iran said the strait was completely open. Today, it's back up 6% after the weekend chaos that ensued. US is seizing Iranian ships, Iran reasserting control over the strait, both sides accusing the other one of violating the ceasefire. We're now sitting at around $87 to $89 a barrel. That's lower than the crisis high, but still elevated. And more importantly, completely unpredictable day to day. And despite all that, the stock market hit an all-time high. How can we make sense of any of this? Professionals whose job it is to determine what's going on are struggling hard. So the average buyer just simply cannot. The ceasefire expires Wednesday evening, and Trump says he's highly unlikely to extend it. Who knows? Iran first said this weekend that may not even show up to talks in Pakistan. Then today, they said, we'll send a delegation. This is the environment we're in, whiplash, and frankly, very difficult to believe anything that is being said. And until this resolves, fixed mortgage rates aren't coming down meaningfully. Here's the chain. Oil stays elevated, inflation concerns persist, central banks stay cautious, bond yields stay high, fixed mortgage rates stay high. Until oil settles meaningfully, and I mean below $85 sustainably, fixed rates aren't coming down much. Now, the US labor market looks resilient on the surface, but jobless claims fell to 207,000 last week, which was better than expected, but here's the historical warning. In the 1973 oil shock, it took about 3 months for the jobless claims to start rising in any meaningful way. We need to keep an eye on that. The lag is real. High energy costs eventually force companies to cut workers to protect margins. We're not there yet, but the clock is ticking. So what does this mean for you? If you're waiting for fixed rates to drop before you buy a house, or you're waiting for the oil to resolve itself, and with the ceasefire expiring in 2 days and no deal in sight, that could take a while. Now, let's look at what's happening in Canadian housing. The numbers are stark. March sales were the weakest in 17 years. Home sales sat 17.3% below their 10-year average in Q1. That's the slowest first quarter since 2009. Korea just slashed their 2026 forecast. In January, they predicted sales would climb 5% this year. Now they're saying 1%. That's a massive revision in only 3 months. The GTA is ground zero. The sales to listing ratio there is 26.1% month to date. That's brutal. It's over 21 points below the national average. But here's what's interesting. And what the doom and gloom headlines miss: there's no flood of listings. Active listings are only 1% above year-ago levels. Months of inventory is at 5 months, which is a balanced market, and it's just slightly above the 20-year average. This isn't a market in a free fall, it's a market in a standoff. Buyers are waiting, sellers who don't have to sell are holding, and the people who need to sell, they're negotiating and they're looking for buyers. That's the dynamic right now, and it creates an opportunity if you know how to see it. So what needs to happen for this market to turn? 3 things. 3 breakthroughs. First, Iran. The oil situation needs to resolve. Whether that's a real peace deal, a toll regime that stabilizes the flows in the strait, or something else, oil needs to settle. That's what unlocks lower yields and eventually lower fixed rates. Second, haven't heard about this in a while, but it's coming, CUSMA. The trade uncertainty with the US is hanging over everything in Canada. Businesses in Canada aren't investing, consumers aren't confident. Until there's clarity on tariffs and trade, that overhang persists, and that drags on the economy. If that deal goes bad and Trump takes the boot to us, then fixed rates will stay stickier. But we could see the Bank of Canada cutting sooner than people think in that environment. Third, rate relief. Buyers need to believe that borrowing costs are stable or falling. Right now, they're not sure. How can they be? So they wait. And right now, all 3 of these things are uncertain. The ceasefire expires in 2 days with no deal in sight. CUSMA negotiations are stalled, and the Bank of Canada is frozen. Waiting for all 3 of these to line up, that could take months, maybe longer. And here's the thing about waiting. A lot of buyers are sitting on the sidelines waiting for fixed rates to come down or this certainty that they want. I get it. Fixed rates are elevated. You're hoping oil settles, the yields will drop, and you get a better deal in a few months. So I'll wait. But here's what you might be missing. If you're waiting for fixed rates, you're solving the wrong problem. Variable rates are already lower right now. There's no change from the Iran war at all. And the spread between fixed and variable has now widened. You can get in today at a lower rate than fixed, and you're not betting on anything risky. Why? Because the same weak housing market that's making you wait and hesitate is exactly why the Bank of Canada won't hike. Think about it. Weakest March sales in 17 years. Weak job market numbers. Weak GDP numbers. Sales are 17% below the 10-year average. Korea just slashed their forecast massively. The GTA has a 26% sales to listing ratio. That's brutal. This is not an economy that can handle rate hikes. The Bank of Canada knows it, and that's why they're frozen. So what does this mean for you? It means taking a variable rate mortgage risk is relatively low. The downside, rates going up, is off the table in this environment. And here's the opportunity most people are missing. Right now, you're shopping in a weak market, fewer buyers, fewer competitors, more negotiating leverage. Sellers who actually need to sell, they're hungry. When the 3 catalysts resolve, Iran, CUSMA, rates, buyers flood back in, competition returns, your leverage disappears. The people waiting for certainty will be competing with everyone else who waited. And all the people move in with that uncertainty, they got the deal. They got the house. When rates drop, they ride variable down, or they convert to fixed at better terms. That's the managed mortgage approach. You don't wait for perfect, you position yourself to win in multiple scenarios. Now, I know what some of you are thinking. Hey, Greg, you just told me the market is weak. Prices could drift lower in that scenario. Why wouldn't I wait for lower prices and lower rates? I'll get both. Fair question. But here's why that's harder than it sounds. First, we're a long way from the bottom. Prices aren't falling very much because of the inventory things I said earlier. So you won't see the bottom until it's behind you. And by the time the headlines say the market has turned or prices are recovering, the bottom's already 3 to 6 months in the rearview mirror. You'll be competing with everyone else who was waiting for that same confirmation. That's the big one. So the second point is that your leverage disappears faster than prices move. Right now, you can negotiate price reductions, conditions that you want, closing dates. Sellers need to sell. When the three catalysts resolve and buyers flood back, that negotiating power evaporates rapidly. Competition returns, bidding wars return. Even if prices drift another 5% while you wait, you might lose 10% in negotiating leverage when the market turns. Third, you're trying to time two bottoms at once, the house price bottom and the interest rate bottom, simultaneously. That's not a strategy, that's a lottery ticket. Even professionals can't time markets consistently, especially these days. And you're trying to nail two of them at the same time. Here's the managed approach. Get into a weaker market while you have leverage. Take the variable rate at a much lower rate, knowing the Bank of Canada isn't hiking into this environment. Negotiate hard on price because you can. If prices drift a bit lower after you buy, you got a negotiated deal, you're in your new home, and your rate floats down when cuts come. If prices turn and start rising, you got in before the crowd. Either way, you're well positioned. You're not sitting on the sidelines hoping to nail the perfect moment that will only recognize, frankly, in hindsight. That's managed. That's how you actually win. So let me give you the call for this week based on where you are. If you're looking to buy a house right now, consider variable. Seriously, the weak market is your leverage. Variable rates gets you a lower rate today. And the same weak market that's scaring everyone else is exactly why the Bank of Canada won't hike. You're not taking on massive risk. You're exploiting an opportunity that disappears when certainty returns. Get in now, negotiate hard, ride the variable down when cuts come, or better yet, even if variable stays flat and some of our catalysts I mentioned sort themselves out, you could see fixed rates settle back to where they were pre-war, and now you get to lock in at a lower rate. Win, win. If you already have a fixed mortgage today over 5%, you should be looking at a relock right now, or exploring whether variable makes sense for you. We have a special program right now where your penalty is completely covered for those people to relock. That's right, you pay nothing out of pocket. The savings from your lower rate is all gravy because you have no penalty to get out of the mortgage you are in. Don't sit in a 5-handle mortgage when mid to low 4s are available. We just did a few this past week, moving people from 5.3% and higher to low 4s and no penalty, all upside. Book a call with us by clicking the link in the description or the pinned comment below. If you already have a variable rate mortgage, you hold. You're perfectly positioned. There's no pressure for rates to rise. The labor market is too weak. The housing market is too weak. The Bank of Canada is frozen. When cuts come, you ride them down. Stay the course. If you're coming up for renewal, this might be the time to consider variable as well, especially if you've been in fixed for years and you're facing a big jump from a low 2% mortgage or even lower 5 years ago to now we're in the mid to high 4s. Ouch. The calculus has changed. Variable rate risk is lower. And if the catalysts resolve and rates drop, you want to be positioned to capture that. Now, let's look at your specific situation together. At a bank, you'd pay the full penalty yourself, probably never even knew this was an option, which is to say you're stuck in an unfair bank high-interest purgatory until your renewal in a few years. That's a lot of unnecessary interest paid. That's the difference between shopping for a rate and managing your mortgage. Here's the bottom line. 3 breakthroughs are needed. Iran, Kuzma, and rates. All 3 are stalled. Everyone's waiting, and that might be exactly the wrong move. The weak market is the opportunity. Variables get you in at a lower rate, and the same weakness that's scaring buyers is why the Bank of Canada won't hike. You don't have the time to time the perfect bottom. You have to position yourself to win in multiple scenarios, and that's managed mortgages. That's what we do. If you want help figuring out your next move, click the link in the description or the pinned comment below to book a call. See you next week.